How do you or can you file your taxes in Italy? That's where things get really complicated. So let's talk about how to file your taxes in Italy in practice using real life examples and numbers to compare three different approaches based on average information you may read online by relying on local rules only, and then by optimizing local and international rules with tax treaties. Which one will you choose? Imagine you're an expat named John, okay? Originally from the United States and now living in Florence, in Italy. John works remotely for a US-based company and he earns around 70,000 euros per year. While he is enjoying his new life in Italy, the tax season is coming. He is overwhelmed by conflicting advice. One website says he only needs to declare his income in the US. Another says he's taxable entirely in Italy. And a third one suggests he'll face double taxation. What should John do now? Many expats fall into this trap of following generic advice found online. I'm not blaming you, okay? And John, for instance, reads that Italy has a flat tax regime for new residents, and he assumes it applies for him. 200,000 substitute tax right away. So he files his taxes based on this big misunderstanding, only to receive a 5-digit fine a month later because he failed to meet the strict criteria for the regime, for the high net worth individuals regime. So let's break down these three possible ways John could file his taxes using real specific examples and numbers. Option number one is filing taxes based on, average information found online. As back as the previous example, John reads online that as an American working remotely, is only subject to US taxes only. He doesn't file even a tax return in Italy, believing that US and Italy tax treaty protects him from dual taxation no matter what happens. So what's the outcome here? John files the US tax return, paying around, let's say, 14,000 based on a 20% effective rate, and then Italian authorities eventually audit him and determine he's being a tax resident of Italy, owning another 21,000 in Italian taxes. And finally, John realizes too late he should have filed taxes in Italy and claimed a foreign tax credit for US taxes, so it ends up paying penalties and interest on top of the 21,000. What's the lesson here? Assuming you're exempt from an Italian fiscal obligation because of a treaty or because you read some online advice can be very costly. So treaties don't override the obligation to file here in Italy, okay? Listen carefully. What's the option two? Well, as you know, filing taxes using only local Italian rules. After this online mistake, if you want, John consults with an Italian accountant who advised him just to file solely under the Italian tax laws. So consequently, the accountant applies the Italian progressive rates, the 23 to 43%. So John now pays 21,950, 22,000 rounded up for the tax authorities. But he forgets to claim the foreign tax credit of the 14,000 paid in the US, basically leaving money on the table. So now John avoids penalties, yes, but overpays because it doesn't account for tax treaty benefits. His effective rate climbs to over 30% when it could have been lower. What's the lesson here? Filing based on purely local rules might keep you compliant, okay, don't get me wrong, but it often leads to unnecessary overpayment or dual taxation, if you know what I mean. Last stage. Determined to get it right, now John speaks finally with an international tax expert who is specialized in expats. So, back from scratch, the expert reviews his fiscal case from the very beginning and suggests a very smart approach. First thing first, the expert confirms John is a tax resident of Italy because of, ties to Italy for more than 103 days. Then the road goes to claiming the foreign tax credit, so paying just the difference to the Italian tax authorities. And then, why not, exploring the different tax regimes So the expert, the international tax expert, can determine that maybe John doesn't qualify for Italy high net worth individual's tax return, but he can benefit from deductions for healthcare, for example, for housing expenses, reducing the taxable basis. So what's the outcome here? Well, the total taxes paid are lower because he pays just the difference. It could be 7,000, 8,000 at most. And at the same time, John complies with both Italian and US laws, at the same time minimizing the overall tax burden. So as you can see, combining local and international rules ensures compliance and maximizes savings. Many expats out there believe that the double taxation treaties automatically exempt them from filing taxes in both countries. In reality, these treaties prevent the dual taxation, but they do not eliminate the obligation to file in each jurisdiction. Additionally, treaties often require careful application, including claiming foreign tax credits or exemptions correctly. John's journey in this case highlights 3 approaches to file your taxes in Italy, 3 very common ones. Filing based on average information might seem easy, but often leads to penalties and overwork. Relying solely on local rules, domestic rules, it can keep you compliant, but can lead you to overpayment. The best approach? Well, you know that. Optimize your taxes using a combination of local and international rules, guided by a professional who really understands both systems. So what about you? Are you filing your taxes the smart way? If you're unsure, please consider consulting with an expert who can navigate, the complexities of international taxation, and why not try to turn your Italian dream into a very easy task.